bigger challenge speaking before lunch when you're hungry or speaking after lunch when you're full. Particularly on a topic like financial markets. Gilbert had asked that we discuss with you the issues of financial market resilience. And when I first read the invitation, I wasn't quite really sure because it seemed to cover a lot. So what I would want to do in the next few minutes is basically tell a story. The formal paper is there. It's been cleared, so basically it's available for anyone to read. But the main story that I will try to tell in the next few minutes is that however it is that we're looking at financial markets today, it's probably not the right way anymore. It requires a totally different set of lens. The issues that have cropped up in the last 20 years or so magnify the points that I will try to raise briefly. And in that context, therefore, the issue of financial market resilience, we have the right answer to the wrong question. And therefore, we are building the right answer to the right question as we move along. So when we talk about financial market resilience, I cannot help but start with a basic question. Okay. Basic question is, what caused the financial crisis? And obviously the practical question answer is a lot. So what exactly does a lot look like? So in the schematic you see houses, you see default rates, you see for sale signs, you see monetary tightening. The official explanation is that the U.S. Mortgage market burst in 2004. It created a credit issue. The credit issue translated to a liquidity issue. And by the time everything was all said and done, the U.S. turmoil had spread to the rest of the world. The formal result of a U.S. inquiry, and it's on screen, and this is, I copied it verbatim. They talk about lapses in governance. They talk about taking on excessive risks. There is a very scathing remark about the inability of regulators to have seen all of this. There is some issue about accountability and ethics. There's issues, obviously, about mortgages and the breakdowns of corporate governance. But after all the red words that you see on screen, the three most important words that I think everybody should look at is that the crisis was avoidable. And I will actually argue otherwise. If it is so avoidable, human nature would have said somebody must have done something. It is not conceivable for rational human beings not to have intervened on a crisis that they saw in advance, if indeed they saw it in advance, and on a crisis that they would have expected the magnitude of the dislocations. Since the entire screen talks about context of the US, I thought it might be a good juxtaposition to try to see where the Philippines is today. And this is the slide I chose. I chose annexes from Fitch and Moody's, where they basically say, if you take a look at the Philippine banking system, Fitch rated the Philippines with a positive outlook for 2016, the only country in the world with a positive outlook for banking for 2016. Moody's, we are one of two countries in the world with a similar positive outlook. If you extend it to which country in the world has had a positive outlook for 3 years or more consecutively, isa lang po yun, Pilipinas lang. So, if we were to believe our own press release, I could stop here. Pogi na eh. The slide before said, laki ng problema sa amin. Is it okay to speak Tagalog, English? I hope it's okay. This makes it less formal. So the previous slide basically said the US had a really big problem and the rest of the world was collateral damage. This slide basically says the Philippine banking system is probably one of the best, if not the best in the world. That's the press release. And for all intents and purposes, I could have just chosen the next slide to show, well, capital adequacy ratios are rising, non-performing loans are falling, liquidity ratios are very high, profitability is consistent despite all of the crisis, and the banking supervision and examination sector has not shied away from closing banks, which we feel in public interest would have been better off closed rather than operating. So, if indeed we believed our own press release, I could actually stop here. But that would be such a great injustice. Because I think, if I remember it correctly, it was Machiavelli who said, we should not waste the opportunities of a great crisis. So the question is, what are the lessons from this great crisis? If you take a look at the 1997 crisis, where there was a mismatch of maturities and tenor buckets in currencies, the traditional conclusion at that time from all the multilateral agencies were banks misbehaved because they gapped. They took in dollars, they lent pesos. They borrowed short-term, 30 days, they lent 20 years. The problem with that analysis is that's what banks do. Since time immemorial, it's their job to transform short-term deposits into long-term loans. It's their job to manage the liquidity. If the liquidity is in foreign currency, it's still their job to intermediate in pesos. So at some point, you have to say, did they just do their job? Or did they cross some magical line? The bigger issue is, and maybe my age is starting to show here, the economics I learned in UP was that banks take deposits and make loans. It's a black box. You talk about money multiplier, Cambridge equations, the effect on liquidity and inflation, but at the end of the day, banking, money and banking, 1-to-1, 2-to-1, is really basically a black box. The lesson from the last two crises is that banks are smarter than that. Banking is much more complicated. There are dynamics in the interbank repo markets. There are dynamics with non-deliverable forwards. You buy spot, you sell forward, you buy forward, you sell spot. There are all sorts of things that bankers can do right now. So that banking is much more dynamic. It's much more active than what the textbooks will say. For those of us who followed the Great Moderation, in the US there was a 18, 20-year period during the time of Chairman Bernanke, where output volatility was very low. It had dropped tremendously to very low levels, so very stable. Inflation was very stable. And they had called it the Great Moderation. And with the Great Moderation, they were able to lower interest rates, and with that, mortgages went down to all-time lows. So you can actually borrow at 2.5 or 1 3/4% for a 20-year housing loans and reprice it after 3-4 years. There was an argument made by Hyman Minsky, who famously said that stability can be very destabilizing. In other words, you can get very complacent. And the argument being made now is maybe Minsky was actually correct. So the so-called Minsky moment. So my take from what we learned from the crisis is that it turns out we probably don't understand financial markets as much as we think we do. Because simply there are so much that's happening within the balance sheet of the bank, across products, across markets, across institutions, and it's not particularly transparent to regulators because we only see the balance sheet. We don't see the decisions that go into the funding of the balance sheet. So when we see the balance sheet, it's at the end of the quarter, it's at the net effect of a decision, rather than the decision that caused the funding of that position. it also creates a problem because if the global financial crisis is now all about systemic risk, where in the balance sheet is systemic risk? Is there a line item there that says if this number goes tremendously high, it's an indicator of systemic risk? Or conversely, is there an accounting entry somewhere in the banking books that will say if this is suspiciously low, something is happening and regulators can come in? I don't think so. I simply don't see it in the balance sheet right now of the banking industry. But the story still remains that of risks. So if you take a look at it, the issue that Gilbert had asked us to talk about is resilience of the financial market. Financial markets are all about risk. So resilience must be about managing risk. But think about it for a while. What are the risks taken by the banks? The blue line, the blue words. Hirap ang recitation dito. Umuutang ang bangko para mag-create ng loan. That's his job. Therefore, the primary risk of a bank has to be credit. Think about a security firm. The position of the security firm is always short. Hindi niya inutang yung pera. Therefore, and every day, their balance sheets are revalued. Mark to market. So it cannot be about credit. Because at the end of the day, the books will close. So what's the risk to a security firm? It's liquidation. It's liquidity risk. Very different from the credit risk of a bank. But take a look at the insurance company. Its risk is not even on the asset side. Its risk is on the liability side. What if it takes too many policies and it cannot pay for it? What if 15 years after, so many kids go to school, there goes your pre-need plan. What if you took on so many risks, you miscalculated your actuarial probabilities, and you can't pay for it? That's on the liability side. That's not on the asset side. So even if we talk about risks, it's kind of hard to put them all together. The blue plus the red plus the green doesn't make much sense. Which takes me back to a more fundamental question, what is financial risk? So pasensya na po, kakakain nyo lang, alam ko, sarap kinain nyo, mag-e-equation ako. Madali lang naman equation. Simple lang. Two asset portfolio. There's asset 1, there's asset 2, therefore, you get a rate of return for the portfolio depending on the rates of return, mu1, mu2, right? And the W's are just risk weights. And the portfolio risk of that is a little bit more tricky type of equation, but this is really financial economics 11 stuff. So for those of you in the room who follow financial markets and financial boring talk, this is the very heart of finance. But take a look at what the equations are saying. All the Greek terms, the mu's, the sigmas, and the rho's, are actually known in advance. So if you're going to maximize this portfolio, the only thing you can move, the only choice variable you have is the W. How much of asset 1 will you buy relative to asset 2? Right? And since the portfolio has to be 100%, so it's either 80-20, 75-25, but it can be minus 100 and plus 200. You're shorting a portfolio. Umutang ka eh. Pag umutang ka, negative. Para magkaroon ka ng doble posisyon doon sa mas malaking risk. Basta ang suma total doon, 100. Right? Now, where does that lead me? Rational human beings will therefore choose W's where the rates of return are highest on the asset. And it's linear in the mu. The problem with that is that it also increases the risk. That's the line at the bottom. If you put them all together, the magical answer is this. This is the risk-return trade-off. And unfortunately, the one thing that economists hate the most with any optimization problem is it's unbounded. Walang dulo. You can always take more returns if you're willing to take more risk. Here lies the problem. Sino po magsasabing sobra? If I were to make my own personal decision about my own personal money, does a regulator have the right to tell me sobra? And what is the basis of sobra? How will any third-party analyst will now say, I think you're taking on too much risk? Remember the slide from the U.S. Inquiry Commission? They said the U.S. agents, market agents, took on excessive risk, categorical in statement. So how do you know it's excessive? It's excessive because the risk didn't pan out. You didn't make money out of it. It blew in your face, so suddenly it's excessive. So are we therefore saying that financial markets have this nasty habit that if you guess right, you're a genius. If you guess wrong, it's a bad market? Which then leads me to the question, what is it that we know about financial markets? Well, I can break it down. I know what I know. The known knowns, which is the column on the left. There are things that I know that I may not really realize I know it, but it's in the back of my head. So it's my unknown knowns. But they're knowns. The problem for financial markets is what happens to the green box, which is I know that I don't know. The known unknowns. Worse is the yellow box. I don't even know that I don't know. So how am I supposed to study something that I don't know, that I should know? So it creates a really big problem. And ladies and gentlemen, the issue of financial resilience and financial market stability boils down to the green and yellow boxes. What is it that we know and what is it that we don't know? In the language that we speak of today, it's called financial stability, the framework of financial stability. And the paper has all of that details. I'll skip the details. I'll draw it for you. What if there are two risks, the purple and the yellow? Risks have this very nasty habit of being non-additive. They're non-linear, they're non-additive, they're not transparent. More importantly, some risks commingle with each other. So financial stability is the issue about those risks that commingle, that we don't see them commingling. And therefore, I go back to my equation. Here are your standalone risks. So the blue boxes are my purple and my yellow circles earlier. And the red box is the intersection of those two risks. So the homework for us regulators is to figure out, I'm expected to know the blue box. Somebody has to guess the red box. And that's the job of the regulator. That's financial stability. Let me just move on a little bit further. I'm being told I have a few minutes left, so hold on a little bit further. I just wanted to emphasize that in financial markets, you cannot look at it in silo. Earlier I said banks, securities, insurance, wala pang payments doon. It's a terrible mistake to take a look at financial markets in its parts. You have to take a look at them in a very cohesive and integrated way. So here's a drawing. What if, siyempre, sensya na po, taga-BSP po ako, so yung banking yung gitna. Doesn't have to be the middle, but I just chose it to be the middle. So the banking sector is in the middle. Cash markets provide the liquidity. The contingent markets provide your hedge and your derivatives. To make it work, I need a payment system. I need a pipeline that transfers payments from A to B and settles obligations. And to make it work, it cannot be just about tomorrow's market. It has to be about markets 20 years from now. So capital markets have to be in play. Drawing ko lang po ito. My point about the drawing is no matter which box you start, you can go around. So the entire system is an integrated nexus of all related issues, whether short-term, long-term payments, physical transfers or obligations, it can be done within the financial market. And the homework for financial stability now is to look for those linkages and see, are there brewing risks? Are there risks that will tell me that there are issues that I need to take a look at? The problem with risk is it's not linear. It's not additive, it's non-linear, and in most cases, it's not even transparent. So, if I were to summarize it this way, the homework of financial stability, therefore, is that the macroprudential risks are not even the sum of the microprudential risks. Yung po yung red box. Hindi mo pwedeng i-add si A and B. So the portfolio risk is not just the risk of A and the risk of B. There's an interaction term somewhere that we don't see. So there's an interconnectedness issue. The third box there basically says none of these equations are 1 plus 1 is 2. May mga exponents and powers and so forth and so on, all the Greek terms, so they're really non-linear in nature. And more importantly, the last point po is that all of us in economics are very much aware of the time inconsistency problem. What makes sense as a decision today may be totally irrational tomorrow morning if market conditions change. So given all of that, the homework that is being presented upon us by the global agenda as a result of the crisis looks something like this. So you have banks, you have Basel III, and that's an entire session. We've had 3-4 days worth of seminars just on Basel III. Dadagdagan ko lang po ng other reforms, which are all in yellow, bullet points on the left. And since I only had 6 units of accounting, when we do the credit rating agencies, I always close my presentations with, it's not about give me an investment grade rating. I always close my presentation with, these are the things that keep me awake at night. And the thing that keeps me awake at night the most is accounting. Kasi hindi ko nakikita eh. By the time it submit sa amin, libro na siya eh. So I cannot see the interactions of the decision. So many other boxes there complete the story. Just to speed up a little bit, the BSP has taken on a formal definition of what financial stability is. It turns out in the literature there is no such definition globally for financial stability. So this is the definition we have. I just wanted to highlight that the entire context of financial stability is that financial markets must work. But for financial markets must work, as I showed you earlier, it's not just about the credit and the liquidity, cash, contingent, capital market. Payments have to be there, so infrastructure is there. But financial markets are inherently risky, so therefore incentive structures are important, and that's where governance comes into play. But financial markets don't make a difference. If the only thing you're going to say is capital adequacy ratios are high, liquidity is solid, and so forth and so on, it has to translate to growth. Because that growth is the metric that all of us feel better through the financial market. If financial well-being is not even improving, then financial markets are not doing their job. Another schematic that we basically use, given all the policy issues that are on the table, this is how I, in my office, organize the agenda. So financial stability is right smack in the middle. There are pre-existing foundations that I need to worry about, risk and capital, market conduct. Once I have that, then I take a look at capital market issues, and of course the inclusion and consumer protection concerns come into play. In the BSP, you will hear a lot of reference to what we refer to as CL2 risks. So even in the speeches of the governor, you will hear a lot of CL2 risk. And by that, what we mean is concentration risk, contagion risk, leverage, and liquidity. The schematic on the right is our analysis of where we are in terms of the linkages, offshore, onshore, so all the boxes relate to each other. Those are the boxes that we currently look at. How do we execute the financial stability agenda? We have a committee in the BSP. It is shared no less than the governor. You have your 3 deputy governors, supervision, monetary policy, as well well as resource management. Resource management handles both the payment side, the treasurer of the bank, assistant governor for treasury is there. I sit in that high-level committee as well as the managing director for monetary policy. These are the things that we look at right now. This is the work plan that we're looking at. In addition to financial stability at the BSP, there is a collaboration across agencies. This is called the Financial Stability Coordination Council. And here are the members of the executive committee. You can see very high level. Governor, Secretary of Finance, SEC, PDIC, the Treasurer of the Republic of the Philippines, the one-downs, and the working committees. So there is a deliberate overlap between the FSCC and FSCOM in terms of our work program. One thing I always want to be sure I include is that financial stability is not just a buzzword. It has to translate to people. So consumer protection, financial inclusion, financial literacy must be part of the financial stability agenda. And we have a specific framework for that. Let me just try to close this right now. I've taken on much more time than I was given. Remember this slide? I said this is how we kind of put it together. Let me muddle it a little bit more. So all the yellow boxes that you see on screen are reform initiatives that are currently being pursued. Let me be very categorical. This is not to say these are the only things we do. It only says, ito lang po yung kasya sa drawing ko. So marami po kami ginagawa. But the bottom line of this particular chart is that ASEAN integration is part of that agenda. So when you take a look at financial market resilience and financial stability, you do have to look cross-border. You do have to worry about what's happening in the region and around the world to be able to put this all together. My last two slides. This is something that the governor has said. Okay, so financial stability is the new prudential norm that we're pursuing. What kind of skill sets do we need to have to be able to attract the best and the brightest? Here's the answer of the governor. You need a financial economist, plus a financial engineer, plus an accountant, plus a commentator, plus a physicist, plus a lawyer, plus a market practitioner. And by the way, they're not 7 people. They're 1 person, 7 skills. So the homework of financial stability is, I cannot create a committee with 7 people with 7 distinct skills for it to work. All 7 must have the 7 skills. That's the only way they will talk. Which creates a real challenge for regulators. Wala pong BS Financial Stability, Masters in Systemic Risk. Wala pong ganung degree. So we're doing this as we move along. And finally, let me just close on this one. The very point that I wanted to raise here was that the enduring lesson of the crisis was something was terribly amiss when you take a look at the components and hope that when components are strong, the system is strong. The lesson of the crisis is that's a fallacy of composition. It is perfectly possible that components are strong, but the system is weak because of that linkages. What is missing is the context of systemic risk. But risk has this nasty habit that it is not very transparent, it is not additive, and it is something that you see after the fact. Therefore, if we cannot figure out a way to manage financial stability as part of our agenda for financial markets, then financial agents, the public at large, regulators, firms, investors, and savers will all be operating in the financial markets as if the risks that they see are real, when in fact they are mispricing the risks and they're not counting the right amount of risks. And therefore, that's the seed of systemic crisis. So the homework right now, if I go back to the point of question posed by Gilbert, is there a magic formula for financial market resilience? We have to change our lens from ratios on capital adequacy, liquidity, profitability, to something called financial stability. We need to be able to measure risks, bearing in mind that risks commingle and change over time, so the time consistency problem is very evident. At the end of the day, therefore, we need a more holistic view. I don't pretend that we have the answer, but we've been working at it for 6 years, and hopefully I don't go back to the office with a crisis waiting for me. Thank you very much.